The Federal Reserve has reduced borrowing costs in the U.S. for the first time this year by an expected 25 basis points. Chair Jerome Powell described the move as a risk management cut in that it's aimed at safeguarding growth rather than a response to a downturn that is already underway. On paper, the U.S. economy looks robust. Second quarter GDP growth has topped 3%, while inflation sits at 2.9%, and the unemployment rate is at 4.3%. But beneath the headline numbers, Powell says pressures are building, particularly in the jobs market. And against this backdrop, their new economic projections show that most Fed officials now anticipate at least 2 more rate cuts by year end. That is a dovish shift from their outlook in June. With the prospect of more rate cuts coming to boost the U.S. labor market, the U.S. dollar fell and the Treasuries sold off. The greenback marked a fresh low for the year, while yields on benchmark 10-year Treasuries edged higher. The prospect of further easing also rattled equities, although history shows the start of an easing cycle has typically delivered gains for the S&P 500 since the 1980s. And for more, we're joined by Stephen Blitz, Chief U.S. Economist at TS Lombard. Stephen, thanks for joining us today. So 25 basis point cut, widely expected. But what do you make of the Fed's signals for 2 more cuts this year, as indicated in dot plot? I mean, what else stood out for you?
Well, I think a couple things stood out for me. One is that they pull forward one of the cuts, right? So they were looking for 50 before the year end. Now they're basically putting out 75. And the market reaction was actually for the 2-year Treasury to sell off. And I think that outlier from Stephen Moran, who was looking for, a sub 3% funds rate by year end. And I think it's an outlier. It was dismissed by Powell in the press conference when he said that, people can have whatever view they want, but to change what the Fed's going to do, he needs to persuade, the member needs to persuade everyone to do what they think is right. And Moran, the only thing he was able to do was persuade Bowman and Waller, who dissented last time, not to dissent this time. So, but the problem is for the markets going forward is come May of next year, there's a new Fed chair, 1 or 2 other new members of the Fed that picked by Trump. Perhaps he also has been able to turn over some of the Fed presidents. And what's an outlier view can suddenly become mainstream. And, Moran's thing about the issue of this third mandate, which Powell again dismissed, correctly so. He said, you're going to get moderate long-term rates if you're right on inflation and employment. But, yield curve control is part of the Trump plan for next year. So, and I think that has the markets a little spooked.
Yeah, when you talk about the outlier view probably becoming mainstream, I mean, I want to know whether this is consistent with the current economic data. Jerome Powell saying that he can no longer say the labor market is very solid. And this is also as we are hearing that they have more rate cut plan. Is this increased worry over the labor market, that it needs a boost in the form of lower interest rates? And how concerning is this for you? Because this is such a stark shift from the July update, which described the market as solid.
Well, when the data changes, people change their mind, right? And I think he got one question saying, gee, if you had this data in July, would you have held your position in July? And he just punted, but as he should. But look, this Fed, really beginning with Yellen and certainly with Powell, has always erred on the side of labor versus inflation. And they have always been very understanding of the political environment from Democrats and Republicans. that there's no runway for them to be Volcker or Greenspan and allow a recession to occur or for unemployment to go over 5%, or you pick a number in the name of getting back to 2% inflation. So now the game here is, or I should challenge more correctly, is that everyone knows that inflation is a lagging indicator, and it lags in the U.S. by about a year. So if you're seeing employment weakening now, and we got really not very good housing start numbers, none of it tells you recession, but it does tell you that the economy, the underpinnings of the economy is beginning to deteriorate. And if that's true, and you wait for the inflation number to come through, then, you know, Powell will have earned his too late moniker from Trump. And he needs to, and because then you'll already be in a recession, and then you'll be chasing to try and get the economy back. So, and as he said, look, this is Fed talk, right? They didn't ease, right? They're less restrictive, and they still view that they are restrictive. I think another 25 basis points, they'll probably be at neutral. To get 75, another 50 basis points from here, I think you need some bad news on unemployment. And they're forecasting that. They're thinking you can get a 4.5% unemployment number by the end of the year. So that gets you that number. And then you need to react to that, and understanding that slow down the economy eventually will slow down inflation.
All right, Stephen, appreciate your time today. Stephen Blitz there, Chief U.S. Economist at TS Lombard.